This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, Chief Investment Officer at PWL Capital, and Cameron Passmore, Chief Executive Officer at PWL Capital.
Welcome to episode 354. Great to see you, Ben. It's super fun for us to welcome this week a longtime professional colleague and friend of both of us. Ben, we've known Jason Pereira for a long time. He's been a financial planner for a long time, is extremely active in the industry, knows lots of people at all different corners of the industry, both in Canada and in the US. And he's an incredible source of financial planning knowledge, industry knowledge, consumer knowledge, regulators, and he's worked at this craft for a long time. So it was super fun to have a great conversation with Jason.
Yep. You know this story, Cameron, I think, although we haven't talked about it in a long time. But Jason is at least part of the reason that I ended up at PWL, because I was weighing a few different options for where I was going to go. I knew I was going to leave the place that I'd started my career in financial services at. I was weighing a few different options, and in just doing my due diligence on the places that I was considering, I ended up coming across Jason's name, and I cold called him. I'd never met him before, and he picked up the phone, and I explained to him what I was considering, and he told me hands down, you got to go work at PWL out of the options that you're presenting here.
I don't think I knew that story.
Oh, no way. Okay. I thought you did. Yeah.
So you must have found him from like Globe and Mail or something, because he has a pretty good public profile and has had a public profile for a long time.
Yeah. Yeah. Well, I found him through just as I was doing the due diligence on the different places that I was considering working at. His name came up, and so anyway, called him, and he was gracious enough to answer, but then also gave me some very clear advice, like go to PWL. That's gonna be the best place. And I didn't talk to him for years after that. And then we become quite good friends. But it's just kind of funny how, like, I've known him as long as I've been in the industry. And he's a big reason that I ended up at PWL. Kind of cool. But yeah, so Jason's been a financial planner for over 20 years here in Canada. He is a sought after speaker. He does the kind of conference circuit in both Canada and the US. His talk, we talked briefly about the talk that he's been asked to do recently, been being asked to do recently on digital intimacy, which is having, I guess what it sounds like, building kind of human relationships using technology when a lot of the relationships are digital. He's a massive source of financial planning knowledge on both Canadian and US financial planning matters. He has his CFP both in Canada and the US. He also hosts a Fintech podcast. We talk a little bit about how technology is impacting financial planning in our conversation here. His knowledge of corporate financial planning is incredible. Like when we do Money Scope episodes, Jason's typically one of the guys that's helping us review the content for accuracy. Like you said, Cameron, he's all over the financial advice and financial planning industry here in Canada. He also does expert witness work, which is just fascinating stuff, where he'll be called in as an external expert to evaluate whether the advice that a different financial planner has given to a client was wrong. So if an advisor is being sued, for example, Jason will be brought in to evaluate whether they were in the wrong or not, which leads to some pretty interesting stuff that he gets to see. And he's a guy who's got a real passion for professionalizing the financial planning industry in Canada, which is a motivation that I really respect. We have talked about Jason throughout the history of this podcast multiple times, which is kind of a funny story. The first time you Cameron brought him up in like the most comically vague way possible, where you referred to him as an advisor we both know who is active on Twitter or something like that.
I try to respect privacy, Ben.
Yeah. When I later became pretty good friends with Jason, he brought that up and just thought it was the funniest thing ever. And then eventually he got mentioned by name, and Harold Geller, who was a guest that Jason mentions in this episode, gave Jason a shout out in his episode. And then when Mark McGrath, who's also friends with Jason, came on the podcast, we started talking about Jason more frequently, but Mark would pretend not to know who he is. Anyway, so he's been kind of scattered throughout the lore, the history of the podcast. And now we finally get to have a conversation with him. We talk about financial planning, like asking him questions as a financial planner. How do you approach this with clients? But then we also talk to him about the industry, where he thinks it is and where he thinks it has to go.
Yeah, great conversation.
All right, let's go ahead to our conversation with Jason Pereira. Jason Pereira, we finally welcome you to the Rational Reminder podcast.
How many episodes has it been? I mean, honestly.
Yeah, it's been a while. It's great to finally have you on here.
Thanks. I'm going to shout out to Luke Swanson, who's been lobbying for this, apparently. So
that is true. He has brought it up multiple times in the guest suggestion thread in the Rational Reminder community. Yep. All right, let's get into some meat here. Jason, what are the core principles of your investment philosophy?
Well, I mean, preaching to the choir here. First off, it starts off with evidence, right? So for my foundation, the foundation of everything should be what the evidence points to, which we know is pointing overwhelmingly to the fact that good luck on the active side, right? So the default should start off with the passive option, right? So the 100% pure broad-based index option. But then from there, I think it's only fair to ask ourselves, is there anything else that can be done? And if so, what's the trade-off, right? And that's where I think both of our affinity for factor-based investing comes from. There's academic evidence supporting that there is a kind of alternative way of indexing through these types of factors to try to capture some of that premium. And it can be done at a cost that does not make the premium evaporate. So it's a fair trade-off. So that's the second piece. Then I also layer on the potential to service clients in certain preferences, right? So we've had a lot of clients come to us about ESG investing or wanting to, have their morality and their values reflected in their investing. And I respect that. I respect the desire. That's their freedom. It's their money. And what I will tell them is that, look, we can't delegate your values. We can't outsource to whatever you think is right with the universe. This just doesn't exist. No product of one exists. But what we can do is we can look at what the marketplace gives us and see what's possible. And there's in our practice, we do two different forms of it. The first is a broad-based kind of screening methodology and weighting methodology around ESG. And that's a combination of factor and index portfolios, index options. And then the last piece came out of some clients' very, very deep personal reasons for not wanting exposure to oil and gas. And the marketplace got to a point where we could do that, again, with passive and factor-based options. Now, we do coach them around the deviation between the normal market returns, the further down the spectrum they go. But really, it's really about that. It starts with evidence. It's based on trade-offs, and it's also reflective of people's preferences around their moral issues. And that's really how we kind of cornerstone it all.
Yep. Like you said, preaching to the choir, that all makes perfect sense to me. I do want to ask about ESG. Have you noticed, like, I don't know, maybe 5 years ago when that was sort of more of a trendy thing, we used to hear about it a lot, not hearing a lot of questions about ESG these days?
Well, the term has become politically loaded in the US, as we know, right? And unfortunately, it's been targeted as being negative for any number of reasons. I don't look at it that way. I value democratic processes. I think democratic processes should also be reflected in your ability to spend your money. And no one should tell you how to invest your money based on your values, right? So full stop. Is there more demand for it? Look, we by default include a conversation. Every conversation we have with a client includes a question around it. And the reason for that is because, first off, we want to make sure we're addressing it. We want to make sure that we're educating them. And if they express an interest, and it's really one question on our questionnaire that says, how important is it that environmental, social, and governance issues are taken into consideration in the management of your portfolio? Not at all. Paramount importance. I'd like to learn more. We have a conversation. We explain the realities. If it's important to them, they make a personal decision around that. But to answer your question in terms of new inbound, I haven't noticed a difference. Now, marketing-wise, yeah, there's a difference. Inbound, not at all.
Yeah, but you're asking about it. That's interesting. It's part of your onboarding process. Mm-hmm.
How do you approach arriving at an asset allocation with your clients, Jason?
So again, let's start with evidence, right? On the equity side, we're going to default to the market cap weighted global portfolio. And as we know, thanks to a lot of the stuff that some of the people who've been on your podcast have done, there is a actual quantifiable reason to have a home country bias, right? In terms of reduction of risk. Again, some of that comes from currency, but your guest did a better job than I ever will at that. So we will tilt that to approximately 1/3 of the equity portion. As for the fixed income side, similar approach, but looking at, again, kind of the factors and evidence around that, which is let's take a broad-based approach. Let's basically specifically target investment grade because the trade-offs on a high yield are just not, the risk return is just not what it should be. And duration around 5 years, which really is kind of a sweet spot for risk return based on what the academic research we've seen is. And basically, with the exception, of course, of when there's an inverted yield curve, and then you start piling up the cash. But effectively, you pick those two goalposts, the far ends, right? You got the stocks and bonds on one side, bonds on the other side, and you control for risk by exposure to each of them, right? So we come up with our default portfolios based off of that, but we also apply the same logic to the 4 different kind of model portfolios we do, which are, again, passive, factor, ESG, and impact.
How do you approach determining each client's risk profile?
So we take a very multidimensional approach to it, and one that's based, again, on a culmination of a number of academic pieces that are out there, right? So we start first and foremost in the initial meeting with the client. We start off talking about experience, talking about their experience with the industry, about their experience in investing, and understanding not just their level of sophistication, but looking for signs of a couple of parameters, specifically risk composure. How do they react in markets? Are they coming to me because markets are down, they're really annoyed by what's going on in their portfolio? Perception of risk. I think anyone who's worked in the industry knows that there's lots of misperception of this, right? People think, well, I'm in Apple because that's safe. Wait, no, that's like one single security in a volatile sector, and you feel it's safe, but that's not necessarily reality. And then preference, right? How much risk do they actually, as an investor, think that they want to take? So we look for those in conversation. And by the way, I'm going to take a step back. All of this is basically founded on work that we read in both Sean Brayman's paper for the OSC on risk methodologies, and also, which I think was a subsequent paper that was done by the CFA Institute on risk tolerance and risk methodology. So we start there. Then the questionnaire includes a risk tolerance questionnaire, and that is based on the old Phenometrica, now Morningstar questionnaire, which is like a gold standard in the industry. That gives us, between those two, all that data, when we're doing the financial plan, we pick the target allocation we think is the best fit for that. And in the financial plan, we then test for capacity based off their goals and throwing Monte Carlo analysis and see if they can absorb the market shocks. We also test for need. What rate of return do they need to earn? Because anything between tolerance and need is an acceptable portfolio that they can choose from. And then in the meetings, we test this. We show them basically the historical upside and downside of not just the portfolio we're looking at, but also other portfolios. And what we're doing there is we're testing for their we're validating that their tolerance or capacity is correct. We tell them what's there, but then we basically just see what their reaction is, and telling them, hey, okay, this is entirely possible that, worst case scenario's portfolio was negative 16% in 1 year. That's $160,000 on a $1 million portfolio. They're going to have if they got a problem with that, they're going to have a visceral reaction at the moment that I say that. And that indicates that we're off, right? So it becomes a discussion around where they would be comfortable. And then the last and final and truest test of it all is composure. When things are going on in the market, good or bad, how are they reacting, right? Are they actually, especially when things go bad, are they calling me panicked? I will say, maybe it's a little bit glib, we get very few calls on market downturns. And I attribute that to all the work we do around planning and making sure that we're not exposing them more than they need to. And oftentimes the new ones will call me in the first downturn and say, well, things must be terrible. Okay, let's play a game. How much do you think you're down? Oh, the market's down 10. I must be close to that. You're down 4. Oh, so you're telling me not to worry about this? Yeah. And sure enough, sooner or later they learn.
And they're down 4, not because of active management or anything like that. They're down 4 because they're in an appropriate asset allocation.
That's it, right? Like there's the best way to prevent an error is to basically not put yourself in that situation in the first place, right?
Exactly.
And we meet plenty of advisors who think 100% equity fits everybody. I guess deal with the emotional aspect of it. That's great until you can't, and then that client does the wrong thing, right? And that can be irreparably damaging.
Well put. Yeah. Okay, let's talk about what might be your favorite F word, fiduciary.
Yes.
Why is it important for investors to seek advice from a fiduciary?
Look, if you were to walk down the street and poll the average person and say, do you think your financial advisor has a legal obligation to act in your best interest at all times? I think most people are going to respond, yeah, or I sure as heck hope so, right? Because the reality is that we're holding ourselves out as people who are there to benefit them. And we should be held to that level of standard of care. So it's all about making sure that we as an industry are not only talking the talk, but walking the walk. And here's the other thing too. I'm a firm believer that the language around this and the understanding of the obligation will change behaviors. Knowing that you're a fiduciary, knowing that you have that obligation, that legal responsibility, that you're going to be held to account, I believe changes actions. And frankly, I think I see that anecdotally across borders when I talk to advisors in Canada, the US, or elsewhere. Higher standards seem to lead to better understanding of markets and planning, at least anecdotally, right? I can point to it leading to better outcomes for clients because it does, but in reality, that's I think the foundation of it. And I'll also say this much, there are certain organizations I won't call out who have literally fought this at every turn, fought the implementation of fiduciary responsibility at every turn. Why do you think that is, right? Why fight a obligation to do what's best for your clients? The only answer is that because it gets in the way of the thing you want to do for yourself.
Yep. There's academic research on that too, that when a fiduciary standard is imposed, the costs of products being recommended drop pretty significantly. I mean, it's a real thing.
Weird how that happens.
Yeah. Why do you think Canada has lagged behind the US so much in the movement toward a sort of the fiduciary advice? Like I'm thinking about the RIA model in the States where they are fiduciaries. In Canada, that model's it's not at the same level.
So there's some cultural issues, there's some structural issues, and there's some luck. Okay, and I think we'll start with the U.S. There's luck around two things. First off, the Investment Advisors Act, which established the ability to become an RIA, which dates back to the late 1930s, basically entrenched within itself the fiduciary responsibility. So as the breakaway started to happen way back, these people were basically becoming fiduciary by nature of the registration, which I think started the entire dialogue and moved things along. You also have a greater history in case law and in other laws like ERISA that governs retirement plans in the U.S., where this has been an ongoing dialogue about degrees of obligation. So the law in the U.S. is more conducive towards basically imposing it on the industry based on registration. So that's your first piece, right? Your second piece comes into, now let's look at Canada and say, how is it different? Well, large financial institution domination, right? What does that lead to, right? Roll the clock back to the US years ago, and the RIA market was not very big. The independent market was still growing. And you see a lot of the same shenanigans you see here. It's a lot of proprietary product, high price stuff. And so you have their profit line as being the primary driver of what gets distributed, right? So do they want to be in a position where they're held to a higher legal obligation? Absolutely not. I mean, there's public statements made by heads of associations like lobbying on behalf of banks that say this outright. And the industry concentration is a problem because there's not enough competition in this country to drive and differentiate the need for people to say, no, we're going to step out and basically be the leaders in this, except for outliers like yourselves. I also like to say, sadly, Canadians have the worst case of Stockholm syndrome when it comes to banks I've ever seen in my life. They simultaneously love and hate them, and simultaneously are willing to pay exorbitant fees to them and just get gouged. And yes, but if you try to basically come in as a competitor, no, you don't have enough bank branches, like whatever else it is. The other piece of it is transparency. Embedded compensation is easier to hide, right? It's easy to pre-CRM2, where basically there was no disclosure of what the advisor was paid. There was plenty of people who basically the advisor just said, well, we're paid by the companies you invested in. Whatever nonsense. You guys have heard all of this, right? Then CRM2 happened, and suddenly the advisor's comp started showing up on statements. But that didn't change that much because it was part of the picture, only part of the picture. The other part was the embedded fees. So plenty of advisors, and I see this all the time when I'm in competition, oh, I only charge you 1%. Okay, but the MERs and the funds that, like, you're getting a 1% trail, the MERs and the funds are 1.4% on top of that, right? The number of times I've had clients, their jaws drop when they suddenly find out it's more than double what they thought they were paying, and they never disclose the account fees, everything else. So lack of transparency has been an issue. Now, this is changing as of Jan 1 with total cost reporting, where all of this is going to show up on statements. And classic Canadian advisor mentality, many of them have no idea this is coming, even though it's been announced for years. So guess what? Clients are going to start getting a rude awakening next year when they start seeing those fee numbers double. And then lastly, I'm going to blame Canada on a culture to some degree. guys, you know what it's like in the US. These people are like born entrepreneurs. Like I can't set foot in the US without having business opportunities thrown at me left, right, and center. They constantly want them to do business. Fantastic. I love that. Here, think about how much more lucrative the independent side is than working the bank channel. The bank channel will take 50% off the top, best case scenario. Best case. I've sat down with advisors, major books at major banks, and said, listen, you can leave with 2/3 of your practice, incorporate, make more money, get the lifetime capital gains exemption, get corporate tax treatment, all of this. And their eyes widen thinking about how much money they're going to make for doing and for having a smaller book. And they're like, why is everybody not doing this? And I said at the same time, let's see if you have the courage to do it in 6 months. We're just not, just lack of entrepreneurship in this country, whatever you want to say it is.
So let's keep going on. Keep going the U.S. versus Canadian comparison. And you talked to lots of people, Jason, all over the industry.
Yeah.
What's your sense as to why Canada has lagged the U.S. so much on index fund adoption?
It's multidimensional, no pun intended. So let's start off with advisor education, right? This is one that I think is underappreciated. There were some changes back in the in the 90s around mutual fund sales practices, specifically around sponsorship of conferences by mutual fund companies, which that money is important to actually have these conferences held. And it limited the sponsorship to only events that had 2/3 mutual fund related content, which led to nothing but multi-decades of talking heads on stage talking about predicting the future. There's no room for practice management, for evidence, for everything else. So it crowds it out, right? So because of the over-reliance on actual manufacturers to provide education, where are advisors getting exposure to this other than, God bless, your conduits, your channels, and other people we know else out there who are preaching the good word, right? So that's the first thing. The second piece is, again, it's easier to hide, right? Like it's easier to hide what you're actually making under these things. Like incentives drive actions. Fear of pushback on fees makes it. If I can say I'm charging 1%, that's all they see, but they haven't looked at the MER. There's that. Basically the product sales focus of this industry in general. I think one of the things that led to, and I see it, we both see when we go to the US, there's this beautiful kind of reinforcing cycle in the US and the public consciousness of a greater understanding of what financial planning is, more people looking for it, more advisors specifically leading with planning, always talking about planning, right? The CFP has basically done, a board has done a great job of publicizing, and you've got this really serendipitous reinforcing circle going on to the point where you can even get undergraduate, graduate, and PhD degrees in financial planning. You can't do that in Canada, right? So they're so much further ahead on the business model because of, I'll credit the independent channel in particular. And one of the reasons that the independent channel basically, how they differentiate it, because think about it, you're competing with these big guys, how do you differentiate? Differentiate on cost and on service, right? So adoption of ETFs largely was basically one of the things pushed by independents as well. So you have that, and so that's a big issue. So the lack of independent channel in Canada is part of the issue, right? Because you think the banks want you selling ETFs? Okay, well, there's different tiers. The branches aren't going to do that because they want to make high revenue off of small dollar accounts. The mid-tier isn't going to do that because it's too lucrative, especially because they're paying salary to the advisors as opposed to what they pay at the brokerage level. And at the brokerage level, they want these guys focused on just selling, not planning. They got planning teams off in the corner, right? Doing the plans, but not actually implementing them. And so if you're there, an investment is your primary means of value proposition. Saying I'm going to do the market, I'm going to do average is not exactly a compelling argument. They're out there trying to beat the guy next to them. So there's just a lot of reasons. And again, I'll also say advisor education, incentives, structure, lack of independence, all of it feeds into itself.
Yeah, makes sense. Switching gears a little bit here, what is the most important role of the financial planner in a client's life?
I wish it was more uniform, but it's not, right? So it depends on the advisors, the planner's value proposition. But I think let's talk about what the end state, the best version of this industry is. The best version of a financial planner is one who basically sits across from another individual and asks them, what is it you want out of life? And let me help you get there. And is your advocate for basically progressing through life and the challenges that basically happen there. To put planning ahead of simple pursuit of wealth. Now, don't get me wrong, the pursuit of wealth is what gets us to be able to achieve the goals we have. But our mutual friend, Brian Portnoy, once coined the term funded contentment, right? unless you figure out what's going to make you happy, unless you figure out what it is you want, the nonstop pursuit of wealth and more just never stops. The hedonistic adaptation, you just keep on moving up. So oftentimes, like, what's more important than a client saying, how much money can I make, or how much money what I flip on clients all the time is I say, listen, if I get you to live the life you want to live and leave behind the legacy you want to leave behind, does it matter what the return number was, as long as it was fair? They all stop and they're just like, you're right, it doesn't. Right? So taking the focus away from the product, from the noise, and specifically getting the focus on what matters to them first and foremost, and guiding them through the actions that will basically help them succeed. That is what planning is at its best. And that basically, when you take that attitude of you're there to help them succeed in life, and I'm sure you guys have seen it. I know you guys do outstanding work. The zone for what you're going to involve yourself with, the things you're going to concern yourself with, increases. The value that you provide starts to exponentially increase, because you're not focused on just, you're not focused on the next sale. You're focused on improving people's lives. So you keep on asking yourself that question, and your service offering expands to meet that need. So that is the best version. It's one who basically is going to expand their service to be as many things to a few people in a deep and powerful way to help them self-actualize the best version of their lives.
And what is the most common misconception you see about what a financial planner actually does?
I think it's twofold. I mean, the general populace thinks it's just about product sales, right? Like, I'm going to invest your money, right? Very few people understand what a financial plan is. And if you look at some of the surveys that come out, they're hilarious, right? There was one, I think BMO did years ago, might be wrong who funded this one, but it was, they said that 50% of Canadians have financial plans. And I'm sitting there going, oh, right, sure. Yeah, right. And then when you dug into the numbers, a full 25% of them said it was in their head. Like, okay. Sure.
Wow.
I've got a unicorn in my head. Doesn't mean I got a unicorn. Right. And then you dug even deeper, and it was, when I actually investigated, some of them were quote unquote investment plans, written or unwritten. And I think the only data I've ever seen on how many, I think JD Power and Associates does a survey on this. And I think they pegged the number at like 7% of the Canadian population has a financial plan. I'm willing to bet it's half of that. Now that being said, the US number is closer to 15, I think. It was more than double. So we got a long way to go on educating people on what planning is. It's not about product. It's about life planning. It's about basically enabling what it is you want out of life. So that's the first thing. The second thing is this concept that the plan is a plan. It's a product. It's a noun, right? A document. Yeah, it is. The document's a snapshot, but that's just a snapshot. It doesn't mean anything unless you implement. And there is a saying that the honest ones around of us say it all the time. It's like, look, it's stale the day where it's written. Absolutely, because your life is going to change. Now, it's close enough to reality the day it's written and printed that we can move forward with that. But then over time, it needs to be constantly updated. It needs to be constantly updated as your life changes, as the situations change around you, as all this information is going to change. So it's not a noun, it's a verb, right? I like to call for things financial plans. I like to use the verb financial planning, because that is exactly what we're doing. We are doing actions. We are not simply creating something.
Yeah, more of a process than a document.
It's a journey, not an end state.
All right, so you've got a podcast dedicated to fintech. What do you think are the most impactful ways that technology is changing financial planning?
Well, I mean, you're asking me this a couple of years after Gen AI come out. So artificial intelligence is changing financial planning, right? And it's changing every aspect of it. Now, the thing is that for the most part, most of the actual work that it's going to do is largely centered around productivity, right? It's going to be more geared towards how do I reduce the administrative burden or expedite the administrative burden and make things move faster. Great. That's going to benefit the entire community, because the less overhead we have, the lower the price, the lower the entry level for clients, right? Because our costs, if they diminish, then we can offer the same level of service to an ever larger number of people, or a lower price point, right? So that's great. Now, the counterpoint, the other aspect of this is happening is that it's also helping with things like financial planning, right? Our friends over at Conquest Planning applied artificial intelligence in multiple forms pre-Gen AI to financial planning. And they created a tool that can produce a financial plan as good as any basic financial planner ever could, very, very quickly, testing more variables than any human being has the time to. So but I say that coyly because it lets basic financial plans get done quickly, but it lets really great financial planners accelerate their ability to a way they never could before. You know, one of the guys there refers to as caddy for planning, right? It tells you what club to use next. It helps you make the decision, but it doesn't. But like, that's a quantitative output. You still got to bring the human aspects into it. But overall, it's allowing me to be more productive and more accurate and get more research done. I mean, just look at ChatGPT's like research capabilities alone, right? The ability to geek out over something that Ben freaking posted on CSI, on Common Sense Investing, and say, is that right? Look at the papers, look at the counterpoints, and just do a deep research dive that were in 15 minutes. I get 10 pages dedicated to the thing. Like, my God. So my ability for learning, my ability for challenging more questions, my ability for research has increased substantially. My ability to produce the end takeaways, reports, whatever else it is doing that. My reduction of administration has done that. And the great thing about all this is it's taking away all the heavy lifting, all the heavy work that is involved with this, and really going to let me focus more on the actual client and the human being, and focus more on what is it beyond the numbers that's not letting this person succeed, right? How is it I can provide more value to this person, right? And expand that offering.
And what do you think are the wrong uses of AI in our world?
Putting private information into a public LLM with no good use case. I mean, like, that's, well, no security. So security is the thing people have to be cognizant of. Like, I don't put any client's information in these things. I go so far as to, I need to extract something from a document. Fine, I'm going to redact all of the personal information, but I'll extract whatever else I need. So I think there's really, it's too early right now, but there's already, I think Australia, last I looked, was already saying that, look, using ChatGPT with client information could be a violation of our privacy laws. We're going to hear a lot more about this. I think if anything, there's a lot of privacy law movement around the world, and it's going to continue on that trend, and AI is going to accelerate that. Also, I mean, reinforcing your own biases. As we know, the way you prompt an AI can deeply can change the answer, right? So I can go in and say, please tell me why dividend investing is the single greatest way to invest, blah, 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 blah. And it will reinforce that behavior, as opposed to prompting it to say, I would like to see the academic literature regarding dividend investing and its validity, right? So it can be, to the tool, a tool in the hands of a craftsman can build something beautiful. A tool in the hands of someone who doesn't know what they're doing can build something dangerous, right? And that, unfortunately, because it's seen as validity, can reinforce false beliefs. And then, of course, we get into the entire, fake news issues that are a big problem.
Yeah, I was thinking about the same thing as you were talking about ChatGPT and AI. That I use it daily for research, but I find that if I didn't have a baseline level of knowledge and expertise on a lot of different topics, on the topics that I'm asking it about, there are a lot of cases where it'll tell me something that I know is wrong, but that it comes across very authoritatively.
Well, it sounds so right. Like,
which is
it is
scary,
sitting in the
right?
quadrant of confidence and confidence and accuracy, but it could be the confidence and inaccuracy quadrant too. So yeah, it's funny because my first reaction when sitting down and playing with ChatGPT for the first time, so I kind of was blown away, took a deep breath and thought to myself, okay, this is interesting. I'm not too threatened by this, because what this has done is it's made the value of the person who can call BS on the AI significantly higher, right? Because at the end of the day, if the basic stuff can be done, if anything can be researched, the most important person in the room is the person who knows if it's true or not. So it doesn't eliminate my need for knowledge. It basically validates it's more important now, because everybody's going to be thinking these things if they're not careful. I'll tell you one of the other cool things I've been doing with AI lately too, in terms of research capabilities, is that your ability to build programs with this stuff is unprecedented. I may host a podcast on Fintech, but I can't code to save my life. And I'm currently working on a case right now for my expert witness cases where I have to stress test with volatility a specific type of universal life policy. So I was trying to figure out how to build this in an Excel document, and I wrote out a page and a half of formulas. And I thought to myself, wait a sec, I can do a spreadsheet. Wrote a 2-paragraph explanation of what I wanted to build, took the formulas and the experimentation, put it into something called Replit, hit go. 10 minutes later, it had a version 1. And it looks pretty accurate. I got to finish stress testing it. But when you start thinking about all the things that, like, and Ben will get this too, when we're researching things, we say, okay, it'd be really cool if I could stress test this to the nth degree, if I could build something that does that. And I mean, you guys got Braden. You're lucky enough to have him be able to do that stuff. But for those of us who don't have a rocket scientist in their office, the reality is that now we're actually able to, potentially even test our theories and our research in a way we never could before.
Yep. Yeah, the coding aspect of it is really cool. Braden has tried using Replit specifically, and like you said, like it's not a super fair comparison because Braden is literally a rocket scientist. He did not love using Replit. Like it didn't write code that he would write. A good friend of mine is he's a data engineer that's currently works for big tech companies, worked for a bunch of them, and we talk about this a lot as well. And he says something similar to what we were just talking about, where it gives us occasionally information that we know with our domain expertise is not perfect, but it comes across really authoritatively. It does that with code too, where it'll write code that, like for you who otherwise couldn't code, it's still super useful. But for someone who's an expert in coding, it'll spit out code that an expert would never write.
100%, and sloppy code. Like I've had friends of mine review it and they're like, this is trash, but it's doing the job, right? But the most important thing, and this is where people got to be careful. This is why one of the things I built into the screen was the most important thing is that you have to audit to make sure it's right.
Right.
I can't take it at face value that it's right. So I've literally programmed auditing screens where I can see like every entry of every Monte Carlo to basically say, okay, like how did you arrive at this, and work backwards and validate. So okay, if I can test that, I don't have to test every Monte Carlo instance over 1,000, but if I can do a couple of cases and then test a few of them and make sure it's all working right, pretty solid probability it's nailed it. If not, I can take correcting steps.
Yeah, but you have to be able to audit it. That's the interesting thing about it, is that it's super useful and it can help scale your time, but you still have to have knowledge and expertise to use it.
And there's the moral hazard, just like taking the answer straight from ChatGPT. Is if you take it straight from there and you don't know enough to call BS, if you just assume that the software you built is 100% accurate, you're in trouble. Also, I would say, like, be smart about it. What's the mission critical thing you're trying to build? Am I going to try to replace Salesforce with it? Absolutely not. A portfolio management software with it? Not even close. But, testing Monte Carlo on a universal life policy? Sure.
Right. Yeah. Yeah. And you can audit the results.
Exactly.
Relatively easily.
Exactly.
Yeah, that's good. Okay. So on the topic of technology, we have a ton of our client relationships that are 100% remote at this point, where we never meet the client or rarely meet the client in person. What should advisors do to maintain strong personal relationships with clients in a primarily digital relationship?
So this is something I've been talking about quite a lot. It's a concept of digital intimacy. It was a term it sounds weird, but I coined with my friends Adam Holt and Derek Notman on their podcast. And I was basically saying, look, digital experience and client intimacy are not things that are separate. You can use one to augment the other. And what we really need is to think about digital intimacy. How do we create client intimacy over digital means, right? So most of my meetings, the vast majority of them are over Zoom. Now, the great thing about it is that that's a new medium. It's a new medium that when I'm facing you face to face, I can't put something up the same way between us that I would in person. And unfortunately, for most of us, we've failed to listen to Marshall McLuhan and the medium being the message, and we've tried to apply the old medium to the new message. And what I mean by that is, great, we got to talk to a client. Let me pull up a PDF of their statement, right? I'm taking digital representations of paper and sharing that. You know what's better than that? A lot of these softwares that we are using day to day now, whether they be portfolio management softwares, financial planning softwares, some of the insurance illustration softwares out there, they are built almost with a consumer mindset in terms of how they're designed. And because of that, there's plenty of times now where I don't even open up the statement. What I'll do is I'll actually open up their portfolio in my portfolio management system, and I'll kind of walk them through a narrative through some screens, and I'll be able to have an interactive conversation with them, right? Another one of my favorite ways to use my financial planning software is Conquest, where I'll turn off all the recommendations, and one by one, I'll turn them on, and they'll see the animation of all the red bars turning to green, and they can stop and ask questions, right? Well, wait a sec. Why would I start CPP at age 70? Why wouldn't I start it now? Because I can take it now. Great question. Let me show you what happens. Slide, boom. They see it immediately. So they basically are not only being able to challenge you, but we are able to respond and get validation to an understanding around the recommendation, right? And the great thing is that they can, again, what they're doing is they're taking over part of the journey. Whereas before with the slide deck, right, I have 10 slides. We can go through 10 slides on this journey. You want me to deviate? I don't have an extra slide here. But you want me to deviate and talk about, you specifically, okay, I'll stop talking about your retirement and I'll focus on that big trip you have coming up and you want to finance for a year off. Okay, great. Let's go over there. This is how we're going to fund it. It allows them to be a participant in the journey. So what I'm saying is that when I'm talking about this, I say, look at your softwares that are out there, right? Look at how they can be used in engagement. Many of them can already. When you're looking at onboarding new things or finding tools that are valuable, can they actually produce something that can be put in front of a client? And more importantly, when I actually consult with technology companies regarding what they're building, I'm telling them to start thinking this way. It's like, don't make me open up a PDF. Give me something dynamic and interactive that I can even send to the client. They can have a dynamic and interactive experience with. Let's embrace the medium more, right? And we're still, very early in our thinking around this. I mean, I'm thinking about it. I'm not sure how many people are really, but it makes for so much more of an entertaining experience, but also, and I showed this once to Megan Lurs. I'm not sure she's been on your podcast before, but well-known behavioral finance expert. And she basically said that I kind of stumbled into the trans-theoretical model of change. I had basically, through doing this kind of validation, showing explanation thing, and basically letting them challenge it, I was hitting 2 or 3 steps of this model that allows people to accept change and accept what they're being told, versus being given a checklist and saying, here it is, this is the end result, trust me. They're actually going to be able to see it.
Yep. Yeah, we were doing, we called it just interactive planning, but same kind of idea in office before things went super remote. And we still do it now. But yeah, people are blown away by going through the whole financial planning process. And like you said, seeing how the outputs change as you change different inputs. I think it's the only way to do it, in my opinion.
Well, I think that having a plan is empowering to a client, a plan they can understand. But I think that sort of interactive understanding that helps them understand what it is and why and where the variations are is education, and it's incredibly empowering. I've had people who felt overwhelmed by the initial presentation saying, well, not really getting how this works. I said, okay, let me try it this way. And I show them in the interactive way, like, oh my God, I get exactly where you're coming from. And they feel so empowered and excited and happy about it, right? And really, how are they going to listen to us unless they actually buy in, right? So anything that helps build that understanding is powerful and can really move the needle for them.
You know what? I think it was Eilert Fishbach, who's a past guest who studies motivation. I'm hopefully not misquoting, but I'm pretty sure she talked about how when someone participates in arriving at something like the amount that they need to save, they'll be much more motivated to actually stick to it. So that makes a lot of sense from that perspective too.
Absolutely. And the thing is that you can literally modify on the fly with some of these softwares now. Like we've had times where clients are like, wait a minute, I told you I had 1,500 per month. Okay, maybe it's more like 1,200. No problem. Let me modify this now. Let's see where this ends up and see if that's material or not, right? And then lo and behold, like, so you're also creating so many different points of buy-in and communication, or they can turn around and say, like, listen, what if I spent more every year? Because maybe I'm not comfortable. And my question becomes, well, do you feel like you should be spending more on the things you're not doing? Like, yeah, I'd like to go and do whatever. Okay, great, let's do that. And show them the net impact and let them make an informed decision.
Yep. So you're talking about planning, Jason. Let's go back to basics. And can you talk about what a high quality financial plan covers?
Yeah. So, I mean, I'm a big believer in keeping this simple. I do a lot of complex planning, but at the end of the day, I like to say it's a process of distillation, right? All the super, brainy, nerdy things we do up here with numbers get distilled down to a financial plan that gets distilled down to a 10-page or 10-slide presentation is the way I look at it. I want people to take in the keystrokes in 10 minutes because their attention starts to drop off pretty heavily after 10 minutes to listen to someone. So you want to be clear. But then you want to have the validation piece, which is the actual plan itself, besides the presentation, right? And that really, I have never been a fan of this concept of this 100-page plan that used to go around for so long, where it was just like, here's everything, and I'm showing you why you pay me to do this. And it's like, to me, there's something so insecure about not being able to speak simply, right? So what goes into it? To me, I'm like, keep this simple. Who am I doing this for? Who's the profile page of the people involved? What are their goals and objectives in life? What's their balance sheet? That's their starting point. What's their income statement? Like, where's the money coming from and going to? How's that changing? What's their asset allocation return assumptions that we're making here, right? Because that's what's going to go forward. What does a projection look like, right? Where's the bar graph that shows them how they're going to do? Where's the stress test that shows them that they're going to be okay, even if something goes wrong? And then what are the recommendations on how they achieve it? And then you want to put, and then an appendix. And frankly, what I just mentioned there should be less than 10 pages before you get to the appendix. The meat of, like, you want to hand someone a big 30-page plan, that's fine. But I've done that. Like, our plans were basically kept down to about 20-ish. I would say, look, don't be overwhelmed by this. It's between these 5 leaves of paper that everything is explained. People are relieved. Now, the appendix, of course, there's some people who want to go deeper, so I would keep it down to like cash flow sheets and asset projections and leave it at that. And I always jokingly at the end of our presentation have a picture of a stack of files and say, okay, this is my coy way of saying that if you want the 200-page plan, I'll give it to you, but you're going to live to regret it. And I'll tell you, maybe 5 times in my career, people are like, okay, I'm not understanding this fully. Like, give me everything. And then they turn around and say, okay, I now know what you're saying. Can we go over the spreadsheet in the back? Yes, we can. Right. So I think sometimes people just want to feel like they're getting value for money. But, you know, anyone who's been to a buffet trying to get value for money knows they leave not feeling not so good. So.
All right. What is the nerdiest piece of financial planning knowledge you can think of that's broadly applicable, though? Like, I don't want to hear about insurance shares, for example. Broadly applicable to, you know, listeners in the audience.
Nerdiest piece of financial. Is it one of the things that drives me nuts?
No, because we have questions about that too.
All right, let's nerdiest piece of financial.
Hypothetically speaking.
Oh man, there's so many. I don't know which one. Like to me, it's just everything. Can we come back to this? Let's park this. I'm gonna try to come back to this later. Okay.
Okay.
We'll see what else we don't tackle.
Yeah, sounds good.
Okay, here's one for you then. What's your favorite? Again, hypothetically speaking, what's your favorite financial planning related argument to get into on the internet? Think outside the box here, Jason. I mean, just imagine you get
outside the box. Outside the box.
I'm just
and it's look. Tabasco's not the best hot sauce. I'm going to call it out right now. Right, McGrath. You know I'm right. You just won't admit it. Okay, first and foremost. Okay. Now that is semi-related to financial planning. Just trust me. But as for the rest of it, I mean, take your pick. The 4% rule, as if God chiseled on stone that thou shalt take 4% and you'll be perfectly fine. Never mind the fact people can't quote it right and think it's 4% per year. You know, dividends are a way to alpha. Like, give me a break. Whole life is immune from market volatility. Don't get me started on that one. You know, alts have low risk. You know, I have very little hair left in my head, and you know, Cliff Asness got there first, and part of it was probably because he was raving about volatility laundering and how that's just not the case. And then the fact that people think they can read a newspaper or stuff online, and that's how I pick my stocks. And I'm going to outperform managers. And it's just like, have you not read enough Michael Lewis books, right? Like, have you not seen, I think it was Patrick O'Shaughnessy said like early on in his podcast, it was like 50, 60 episodes that he's like, I'm just going to start. I realized I should have called this podcast, This Is Who You're Up Against, right? Like, this is a guy talking to the most sophisticated hedge fund managers in the world and the resources they bring to bear. And when you realize that this is like, you're either being killed or the killer in the market, really, or you're taking the average. But like, you're either the prey or the predator. There's no way reading yesterday's stale news has anything to do with actually succeeding. And you know what? The reality is that you want to argue with me about that? Like, usually you're just arguing vibes and feelings because I'm throwing stuff at you that proves it. So it is what it is.
I've definitely seen you get into all of those arguments on the internet.
Yes. It's a wonderful place.
What role should mortality pooling theoretically play in financial planning?
Okay, so to define that for those who aren't going to know, like mortality risk pooling is what you get when you're a member of a pension or an annuity, and you theoretically, and you benefit if the longer you live because people who died before you basically left behind either return or their money, whatever else it is. But that's basically it. So the classic financial advisor and planner answer, it depends. Look, for some people, it doesn't matter at all. Like we're privileged enough to deal with clients who are so wealthy that they earn 0% rate of return for the rest of their lives. They're going to be perfectly fine. But even for them, maybe they want to simply lock in their annuity, for example, guarantee themselves an income stream for life, take greater risk in the rest of their portfolio and leave a larger estate. That's possible if that's what they want to do. For others, where it's not the case, look, there's a kind of a middle ground, right? There's those who have so little that they're not going to be able to hit their goals, and no amount of mortality risk pooling is going to do anything. But there's a middle ground in between, where we do a financial plan, we test the Monte Carlo test or whatever test we're going to test, and we find that, look, the probability is not great. Is there a way to enhance this? And the answer, if we throw an annuity in, sometime can increase something that was in the 60s to the 90s, right? So what role does it play? It's case specific. Can it help people? Absolutely. And especially, I mean, selection bias here, especially if you are someone with longevity and health in your family and all this other stuff, you're basically going to win this bet. I mean, I like to joke, my wife is the teacher's pension plan's worst nightmare. her grandmother died 6 months before her 101st birthday, right? So like, I'm sitting there going like, she's going to retire like 56. This is a no-brainer to me. She's going to win this thing, God touch wood, God bless, right? But so the answer is, again, it depends. So it depends on the personal financial situation, but also, are you the person with 3 heart attacks and the stroke and everything else? Like, you're not long for this world. Are you the person with longevity in the family? You are, right? So there's a middle ground. But there's also, again, I think, frankly, when I get to the age where maybe I buy in a lot, maybe I look at an annuity or whatever products exist in the market, do I consider like locking in some of my spending in such a manner? Yeah, I probably would, because again, I think I'm on the longer tail, probably based on health and history. And if that's the case, then hey, why not take some of that stress out of the marketplace? Why not basically benefit from the mortality risk pooling and make my situation more secure?
Totally sensible. So why is mortality pooling such a hard sell to clients?
So different theories on this. I think first off, it comes down to, when it comes to buying annuities, right? It's the endowment effect, right? Like, you're asking people to part with a check, which might be the second biggest check to buy something that they've done, short of buying a house, right? Like, we're talking usually 5, 6, 7-figure numbers, right? So there's a lot of fright there, and it's something that they're not going to be able to undo the next day, right? So I mean, there's a cooling off period, but next month they're not going to be able to do it next month. So the point is that endowment effect, I think, is incredibly powerful, right? There's also, I think, a lack of understanding of the upside of the upside of mortality risk pooling, right? Everybody's like, well, interest rates could be higher in 6 months. I can do better. That's beside the point. That's beside the point, because that's 6 months from now. But the reality is that if you're beyond average life expectancy, the mortality credits are so much bigger than you would ever earn in that delta in interest. It's an issue, right? Like, you're gonna basically make a lot more. And then the other idea is that basically, I think that the entire idea of not keeping, again, endowment effect, the entire idea of not getting back what you put into it. You can get refund annuities, but they pay less. I think that bothers people. And then there is an entire like morbid aspect of this, right? It's like, wait a minute, I'm benefiting from people dying. Yeah, you are. You want to be part of the teacher's pension plan or hoop? Most people do, right? Like, you take that, but the reality is that when you're making a decision on a personal level, and that's how you learn about that, that's how it works. Some people think it's pretty morbid. So, but one last thing, we don't have a lot of good options in Canada. We don't have a variable annuity market like the US does, where it comes with additional tax deferral benefits. I think that tax deferral benefit really does basically lead to more sales in that marketplace as well. Whereas, because we just don't have that benefit, it's purely a play on longevity, which is not as compelling.
Canada had these products launched over the last 5 or so years that were, we called them tontines, which they weren't technically, but it's like a blend of an annuity and an investment product. And they seem really interesting. Like, you and I, Jason, chatted about them a ton when they first came out, and we were like, this is pretty cool. But they have not been successful. Why do you think they've kind of failed?
I was actually looking back here from Malevsky's book on tontines. It's somewhere around there. So look, these are products which are investment products with a mortality risk pool. So no insurance company, but you are basically putting money into a pool. And if you live longer, you win. And if you don't, you basically are giving something up, whether that be the entire amount or just your return, right? So it's a way of getting an annuity, or a variable payout on the annuity, because it depends on what happens to the pool, that is far more affordable than an annuity, right? And the reason why, I mean, like, why did it not take off in Canada? Look, first and foremost, advisor education, lack of understanding. I just know, even online, the conversations or arguments or debates I get into with advisors regarding longevity planning is orders of magnitude more sophisticated with American advisors than it is in Canada. Like, we just don't talk about it here. Retirement planning is retirement income planning is like, let's shift them to dividend paying stock and put a cash wedge in, which, by the way, is a term that only exists in Canada. So that tells you something's wrong. So it's a complete and total lack of appreciation for the challenges of mortality in Canada. I even wrote a series in the Globe and Mail on this, on looking at different products, but also explaining mortality planning in general. So that, I think, first and foremost, is if you don't understand how the problem really works, or how the problem actually exists, then you don't understand the need to solve it. And then you have the second piece, which is on the product side. Again, there's some complexity to this, right? I mean, I reverse engineered the math on some of this stuff, and it's not easy, right? But the reality is, I looked at this and said, like, hey, I'll call out Purpose is the only one who's still got one left, and I'll call them out on it. The assumptions they used on that thing were very conservative, very conservative. And I was like, okay, great. you set yourself up for future distributions increasing at a faster rate than would otherwise. Now, that whether that happens or not, that's entirely up to chance in the market. But the reality is, I'm looking at this and I've spoken to them about marketing it. And I said, listen, what you really need to do is you need to tell, play to, for lack of a better term, play to greed, right? Show them charts on like what the projected payouts are later on in life and how much of that's made up of mortality credits. Because right now, the distributions are largely returned with tiny little bit of mortality credit, if that at all. But over time, roll the camera forward 20 years, and the mortality credit's going to start to far exceed the interest payment. So when you start to, if people understood the upside of mortality credits, I think there would be far more demand for it. And then the last part is, and I'll say this much, there unfortunately is no model framework that's fully accepted in academia for a calculator on, okay, I've got conventional investments, annuities, and tontines. How do I allocate between the three to get the optimal scenario? It's not there. It doesn't exist yet. There used to be one of these for older products called guaranteed minimum draw benefits, which again, I'll credit Milewski. He created that, which you hit a button and boom, it was like, here's the product allocation between the three that gives you the optimal outcome. It doesn't exist for tontines. So not knowing exactly how much of this you should even expose people to is a challenge.
When does permanent life insurance make sense?
Okay. So let's look at life insurance in general. Okay. There's three different needs it services. First is indemnity. I die today. I'm taking care of the people I left behind because I haven't amassed enough wealth to make sure my kids and my wife are going to be fine, right? That's the first piece. The second piece of the other end of the spectrum is I have a permanent need or a semi-permanent need. I own a business. I have no plans on selling it anytime soon. I'm going to eventually die. I'm going to pass it on to my kids, whatever else it is. I have a tax bill associated with that business or a cottage, which is far more common, right? Maybe I even take steps to freeze that so I know with certainty what the amount is going to be. I have a need that is 100% conducive to my death, whether it happens today or 50 years in the future, okay? I have effectively a permanent need, 100%. Where things get muddy is when we start using it for the third reason, which is for an investment vehicle, right? So what does it make sense? It makes sense when first and foremost, there is a permanent need. Now, on the investment vehicle piece, that's debatable, right? And of course, Ben and I have been doing some early work on use of whole life as an investment vehicle. And I will say right now that it should not be the first investment vehicle, okay? RSPs, TFSAs, FHSAs, everything else, they have benefits. When you start getting into a taxable environment, is there a benefit to this stuff? The answer is, it depends as always, but it depends first and foremost on risk tolerance. The more conservative an investor you are, the more likely it is to be a positive outcome with that. So compare it to being a GIC owner or in the US CDs, right? Where you have taking no risk, right? So in that type of investment, when you compare it to a whole life policy, it starts to look a little similar, right? The value can't drop. You get returns every year and then you reinvest those and they can't drop. Now, the return or the dividends will change over time, or the projected schedule will change over time depending on age and market performance, but it can actually be a reasonable substitute for really conservative investments. And especially because that par pool is invested in diversified investments, you're getting the benefit of returns that are conducive to those higher investments that you normally would invest yourself, right? So there is potentially a place here, but we also remember that even though people tout the fact that you can borrow against it and it's flexible and other stuff, there is an inherent inflexibility to it as well, right? So you can't just, you cash it out, you got to pay tax. There's a number of things you got to be aware of when it comes to the handcuffs. So not as a first option, but as an option for the people where it works, yeah, it's viable.
Yeah, there's a place for it, but it's often talked about or sold as if everybody should have a lot of it.
Well, to a man with a hammer, everything's a nail. And this is the problem: is it appropriately sold? I would say that it's oversold. And I think have you had Cole on the podcast yet? Anyway,
No.
So we've seen his work before, and he talked about incentives in various studies and found that yes, it tends to be sold, but when you change compensation models, suddenly other stuff that's expensive starts to be sold. So lo and behold. Okay, nerdiest piece of financial trivia. I'll give it for you. Okay, is that, and I get into arguments about this. Dividends are not tax effective. Everybody always points and says, "Oh, look, I pay less tax on dividends." Right? Now, for anyone who works with small business owners in Canada, we know how things work. There's something called integration. And that means that by the time you add the corporate tax bill and the personal tax bill, it's the same thing as you earning it personally. So when people say, well, dividends are a way to tax effectively for companies to tax effectively return money to investors. No, they paid tax, you pay tax, total equals the same. It's like basically you ordered out for fries, and the delivery guy ate 15-20% of your fries before they arrived, and then you imagine it didn't happen. You have less. So when you actually look at, again, own goals, and then when you look at foreign dividends, it's even worse, right? Because they're not tax efficient at all. In fact, in a corporation, they're even worse off. So they're not a real tax. They're in no way a tax efficient means of returning to money to investors, except for in TFSAs and other tax shelter vehicles. But that just puts them on par with capital gains in other forms too, right? So it's not a big deal. But when you think about it, and you realize that interest gets deducted from an income statement on a corporation and paid out, and then is taxed fully in an individual's hands, you're literally paying the same tax bill on dividends and interest, whether you own the bond or the stock. Capital gains are the only thing that actually have a tax preference. In particular, and I'll never understand people who think buybacks are a bad thing. I think didn't you have, I think Ken French said they separate the people who understand corporate finance from those who don't.
Correct.
I love that line. Because at the end of the day, I don't have to participate in the capital. I don't have to realize tax I don't want to, but I can participate when I choose to. And then I get the preferential rate. So, and it's just the same amount of money leaving a corporation. So what's the point? So that's the nerdiest piece, is that what you think is tax efficient, sorry to break it to you, it ain't.
That's a good one.
Yeah, no, that's a good one. And people look at the amount of tax that you pay on dividends at low tax brackets in Canada, and they think that that's tax-free, that you're not paying any tax. You're not paying any personal income tax, but the reason you're not is because the corporation paid your personal tax bill for you effectively, but the tax was still paid.
Yeah, and people will say to me, well, I don't care what the corporation paid. It's like, well, wait a minute, then you think that they wouldn't pay you more if they didn't have this tax bill? Oh, well, the corporate, they're just going to pay themselves more. I'm like, then why do they pay dividends at all? Right? There's this never-ending, this is the online arguments, right? These never-ending trail of nonsense arguments. Like, if they're paying dividends, it's because they have excess capital and they have a retention ratio. If they pay less tax, that retention ratio stays the same, more money comes out. So
Correct.
End of story.
Or your capital goes down by the amount of tax that the corporation paid. So it's
exactly.
There's no free money.
There is no free money. Like this entire dividends are free money. Okay, let's walk away from that one.
That was good though. That's a good, broadly applicable and very nerdy piece of financial planning knowledge.
Yep.
Nailed it. You had some good articles in the Globe Mail recently on this. How should financial planners approach estimating a client's life expectancy?
Yeah, it's a tricky one. So I will say first and foremost, you start with the FP Canada guidelines. So FP Canada is, of course, the certifying body of the CFP board. Ben, you serve on the committee for guidelines. Thank you very much for your service. But they include at the back of that, in that report, the CPM 2000 tables. This is for Canadian pensioners. Now, here's the thing. People understand that there's more than one type of mortality table, right? I mean, there's gender-based mortality tables. There's smoking, non-smoking based, but CPM is for pensioners. Now, there's a phenomenon where people who collect pensions live longer than people who don't. Maybe it's due to income security. We can speculate. I'm not going to get into that. But the point is that inherently, by using the longer-lived mortality tables, FP Canada is saying use the more conservative assumption. That's a great starting point. Okay, so you start with that, and they will tell you that you should start there. Now, the thing you got to remember about mortality is that life expectancy is a 50% interval, which means your odds of living beyond it are beyond 50%. So you can't, or are 50% exactly. So you can't just use the 50% interval. So I think FP Canada's guidelines are to use the 25% interval and then potentially add another couple of years. I think that's a great starting point. I think that they've done the right conservative thing. Now, people hate the conservative thing because it means theoretically, if you're trying to bounce the last check, you spend less money. Frankly, I always make the bad joke that if you're bouncing the last check, it better be for the thing that kills you, because there's no way to guarantee that. But you start with that, and then you have to take personal situation into consideration, right? Again, are they super healthy, like member of another clinic, jog all the time, long-lived parents? Those things all point towards you're probably going to win this bet. And then on the other side of it, are you the guy who's had 3 heart attacks and is massively overweight and doesn't work out at all? Adjust it. But the other thing is that doesn't get mentioned, and this was mentioned in an article by an advisor who services the Indigenous community in Canada, basically said that basically, First Nations average life expectancy is lower in general because of various issues and social issues. So when you tell them that you're planning for age 90, it's almost insulting to them, right? So I think we have to be, as planners, aware of who the individual is across from us, from health-wise and maybe other issues. to inform that decision, to inform that talk, right? As opposed to just applying a simple rule all the time. Now, that being said, if you want to start with that simple rule and the client says, look, I'm not going to live that long, it's like, okay, great. Let's have that conversation. Why is it you think that, right? Oh, none of my parents lived that long. Okay, well, lifespans have gone on. How did they pass away? Well, natural cause. Okay, fine. You can have this back and forth and educate them to say, like, oftentimes people say, why are you doing that? Life expectancy is only 84. And I'm like, okay, here's how life expectancy works. 50% chance you live beyond it. You have believe it or not, you and your spouse have a 1 in 10 chance of one of you living past that age. Really? Yeah, that's real. That's something we got to plan for.
I find the data on income and both life expectancy and health span, I find those data to be super uncomfortable, because there's big gaps between the lowest income and highest income life expectancy and health span in Canada, which is a pretty ugly fact.
It is ugly, but at the end of the day, there's a correlation between wealth and outcome and health. That's just it. Unfortunately, some of it's job determination, because again, higher paying jobs, with some exceptions, tend to be more white collar and less brutal. And then, of course, health spend. It's a big delta. I mean, it's some of us have the option of going to the U.S. or elsewhere if we feel like the lines are too long here, right? Like, it's a thing. Not everyone's got that option.
Yeah.
So here's a subject, Jason, you know a little bit about. What financial designations should clients be looking for when they hire a financial advisor?
Good question. So you said advisor, right? Let's just establish something. Financial planner is a term that's well-defined and has an ISO code and has international standards body and has regional standards councils that put in place regional designations. Financial advisors, 2 words put together that, even though some provinces license it, I was not in favor of that because there's no clear definition as to what that means. So let's talk about planners, right? Okay. So, we'll talk about designations and go back to that. So first off, you can't take titles at face value, right? And at least there's been some work done in Canada to stop making everyone in a bank a vice president, which was just absurd. But it's still a thing to some lesser degree. And there are some provinces that prevent you from using the term financial planner unless you actually have certain designations. All positive steps. So first and foremost, the CFP, the certified financial planner, accept no imitations. There is an imitator out there, but it's the only acronym CFP. That is the global standard. That is the first thing you should be looking for when dealing with the planner. Okay, they've done a lot of work to bring that standard up, and I'm very happy and confident with the level of testing and the level of what is expected to be known for someone in there. Then from there, there's the other financial planning. Again, I'm biased here. I'm on the board, but the RFP designation, the Registered Financial Planning designation, is a secondary designation beyond the CFP. That is a smaller group of financial planners who are actually actively engaged in the business of producing actual financial plans. So you can get a CFP and never produce a financial plan, but an RFP, you can't be that. Okay. Not to say the CFP isn't great. It's great, but it's a different level of specialization to me. Of course, on the investing side, CFA, Ben and I both survived PTSD with that one. It was brutal. It's not fully necessary, but it is something that does say that person's committed themselves to a level of understanding of the markets.
Sure does.
Sorry?
Sure does.
Yeah.
I agree.
It really does. You're committing yourself to pain and possibly breaking up your relationships when you take that. Okay. I saw it happen to other people. The TEP, Trust and Estate Practitioners, basically a very growing one in Canada, right? Not as recognized in the US. There's other ones in the US, but actually Canada has the highest number of TEPs in the world. So this is one where it's an estate planning and tax planning designation specifically around estates. So if you're doing that, you've got a certain level of proficiency around trusts and estates that, frankly, no other designation can touch. Of course, one of the things that the industry does lack is a tax designation, other than someone having a CPA or whatever. Like, CPA is not necessary for financial planning, but I would love to see someone come up with a highly credible tax and accounting designation that advisors could flock to, that would teach us about specifically. And I would also say I'd love to see that happen around corporate planning, because there's a separate level there. So unfortunately, there's way too many designations out there. I myself dropped all my CSI designations because I felt they weren't valid or weren't living up to a standard that I held myself to. Too bad, CSI, live with it. The rest of, but the ones I named are all stellar. What I would love to see is a lot of the lower bar designations that are out there that exist to get certifications, to give someone 3 letters behind their name. I want to see them disappear. I want to see them replaced with high caliber things that focus on areas that truly matter. Things like cross-border planning, things like around actual, I mean, oh geez, what is the one in the US? The Financial Therapy Association. I can't remember if they have a designation or not, but the reality is like actually being able to deal with the human side of advice. Like these are the things that we need to basically hold ourselves up to, is to a professional level designation, not something that checks a box. So those ones, CFP, RFP, CFA, TEP, CPA, good luck finding all of those in one person. If you do, you found someone who actually cares about learning.
Yeah, RFP is specific to Canada, right?
It is.
Yeah.
Yeah. One other one to mention, I mean, CLU needs an overhaul. It used to be better, I would say that much. It also is not connected to the actual CLU in the US. It's just its own Canadian version. But hopefully they will overhaul that. I know people who've been lobbying for that, but we'll see what happens. But that's a specific life insurance one.
So CLU in Canada, maybe not so interesting. CLU in the US, different though?
Absolutely, it is. I know people who've taught it at the American College, and I know people at the American College, and they hold themselves to a very high standard around responsibility and best duty of care to the clients. So it's a different bar in different countries. Fortunately, well, I mean, sorry, the American College controls the CLU in many countries, not Canada. No alignment.
So financial designations don't always tell the whole story. I agree completely. They show dedication. They show a baseline level of knowledge. How else do you think people should approach evaluating a potential advisor before hiring them?
Look, I wish it was easier, right? I wish that there was a level of professional standard that basically made you feel like you could go to anyone and at least get a base level of knowledge, right? Doctor, you walk into a doctor's office and you believe, and you should, because they're an MD, you have a base level of knowledge. CPAs, there's a base level of knowledge established, right? And so like they should hopefully be able to file their taxes without major errors. But we don't have the same kind of criteria yet in Canada. We're starting to get there around planning and everything else. So look, there's lots of checklists online around this, and I think that that's something you should always consider. And a former guest of yours, Harold Geller, and I have done a couple of podcasts on what to look for and red flags and whatever. And I'll tell you some of the key takeaways. First off, you don't want someone who's coming out selling product, right? I've literally had cases where we sat down with prospects, and we've gone through, they've asked us like, well, what'd you invest me? I'm like, we have no idea. Like, we have no idea. We just met you. Like, we got to do the financial plan, the profiling, all this other stuff. And they're like, wow, that's a really different answer than the other people I went to go see. I'm like, what did they say to you? It's like, oh, they said, well, this is how I work. And then they pull out a sheet and say, this is the portfolio I put you in, but don't worry, if you want to change anything, we can. I'm just like, they had the solution, this magic box that somehow met your needs exactly without ever speaking to you. What a magic box that was. I would love to have this magic box that can pull things that are just answers to questions that haven't been asked yet, right? So like, if they're coming out trying to lead with how they're going to outperform, how they're going to protect you, how they're going to give you all this, like, walk away. You've run into a product salesperson. Second piece, is there a process? Is there a process that basically is going to be, that you can hold them to account? I'm going to do this, that, and the other thing. Everybody promises everything in this business. How much of it gets delivered, right? So basically this, that, and the other thing. Okay, great. How is it going to check all the boxes that need to matter to me in my life? And is this clearly, in that conversation, it should be very planning centric. What are the objectives you're trying to do? Is there an inherent amount of, when you're onboarding, inherent amount of financial literacy happening that are basically, they are helping you understand why you're making these decisions, right? What is are they focused on your objectives? Like, our conversations are all about, okay, well, that's nice. We'll get to that. Tell us about you. Tell us about your kids. Tell us about what you want out of life. Is that what you want? And like, we're fishing for understanding what's making them tick, right? Are they doing that? Or are they too busy talking about markets, right? And then when it comes time to talk about markets, are they properly risk profiling you? Are they taking that into consideration? Are they talking more about the downside potential than the upside? Because look, we're all going to get upside over time, but we all got to live with the downside. Are they coaching you and getting you ready for that? Are they basically, if they're going to sell you an insurance product, have they actually quantified the why? Have they done a needs analysis to show you all that, right? Not to say that, again, I don't want to denigrate sales, because sales is a necessary component of what we do. But when it's the thing that is the reason why you're doing it, it's wrong. It should be following the actual line of logic that fits the person's situation. So it's all of those things. And I will say, unfortunately, people will often go to the people they know and say, oh, do you like your financial advisor? Great, make an introduction. It's the blind leading the blind. They don't know.
Right.
They don't know if the person's doing a good job or not.
Speaking of good job, you do a fair amount of expert witness work. What are the biggest red flags you look for when you review a case?
Oof. Yeah. Usually they're pretty easy to find. So first off, show your work. Like, okay, great, you made recommendations. Like, how did you even arrive at this? Was a risk tolerance assessment of any form, shape or form done? Did you even take the time to even fill out the KYC documents properly? Where are your notes? Like, you made a recommendation. What led to this recommendation? Is
Sorry,
this actually valid?
Just for context for listeners, so you'll be pulled in as an expert witness to a case where an advisor has apparently done something wrong to harm a
Yep.
client, and
Yes.
you're brought in as the third party expert to evaluate whether they have in fact done something wrong.
Yep, I'll evaluate the work that was done. I'll evaluate it both from a academic and from a quantitative standpoint, where they basically doing that, and a regulatory standpoint that they live up to their duty of care, and potentially any other standards that that person's held up to. And oftentimes, I'll have to assess damages, right? And I'll talk about that at the end. But like, you made a bunch of recommendations. What was it based on, right? Did it come out of thin air? Because here's the reality. If you have them in a portfolio and nothing leading up to that, then my response is, I have no idea how they arrived at this. Do your KYC entries even make any sense? I've literally seen, because we had up in our Know Your Client documents, we have to say, okay, the goals of this account are this much income, this much growth, this much security, high, medium risk, low risk. And then I've seen these ones where it's like, oh, they want 80% income, 20% capital preservation, yet somehow you have them in 95% high risk and speculative. Explain to me how so you're finding where there was like, you're either demonstrating to me that you had a line of logic and reasoning that led to a conclusion that basically did the best thing for the client, or if you haven't done that, there's deficiencies all the way that I'm looking for. So that's the first thing. Then, did you even understand what it was you were recommending? With the things you said, did they betray the fact that you do not have a knowledge of what the heck you're talking about? Because I will see that. I got a case right now where around some insurance statements where I'm just like, that's empirically invalid. That's not true. That's absolutely not true. You don't even understand the technical things you're talking about. So, one of the things, like, back to designations, licensing, unfortunately, is not really a bar. It's a line on the floor that's easy to step over in some places, right? So the reality is that if you're not trying to uplift your knowledge and understand these things, odds are you're gonna make these mistakes. So you have to really understand what it is you're saying, right? Complete and total lack of process. Like, what was the journey you were taking the client through? What did you promise them versus what they actually did? Lack of continuous update and communication, lack of records. I got one right now with a 5-year gap in records. Like, there was changes made in the portfolio. Explain to me how this happened. You're not discretionary manager, but the changes happened, right? And basically, or the same solution for every case. Hey, everybody should be 100% equity. That's an opinion. That ain't fact, and that ain't the law, and that ain't regulation. So, guess what? The second that client complains about you and files a suit, they've got grounds. Now, how do I assess damages? Any number of ways. But the simplest way is to basically say, you gave them a bunch of money over time. What does that line look like? Now, I'm going to properly risk profile them. I'm going to maybe do a bit of a financial plan for them. I'm going to do the proper job along the way. Again, depends on how long it was and if the person's still around, any number of issues. And say, okay, based on reasonable assumptions. By the way, projection assumptions are one of the things people are constantly screwing up. They're like, oh, you're going to grow conservatively at 7.5% to 12%. Excuse me, 12%? 12% conservatively. You looked at the projection guidelines recently? Anyway, and then basically say, your portfolio ended up here. If you had done the right job and put them in a diversified portfolio, they'd end up here. But here's the thing. Let's say they're 100% equity and they end up down here. I had a case very similar to this where they lost $1.2 million. Okay? If they had basically been in a conservative portfolio, look, it was a hard time. It wasn't great. They would have lost like $200,000. So $1 million in damages. But here's the problem. You exposed them to 100% equity risk. They should have been rewarded for that. Never mind what I say the portfolio should have been. What did the globally diversified market portfolio do at the time? Oh, look, it's up here. What did the 100% equity? What did the 100% equity index do at the time for US? Guess what? Now I have 3 data points, and I can argue that if you've done it right, should be here. They should be there. Great. You've done this right, would it be here? But what actually happened, what you should have done based on your decisions, because you were too busy stock picking and thinking you could beat the market, if you just put it in that market, you would be up here. So suddenly a $1.2 million loss was $2.5 million in damages.
Yeah. And in that case, it's like the client, it's an issue because the client probably didn't realize that they were taking not only equity risk, but they were taking speculative risk from individual security selection. And neither of those probably matched with their the appropriate amount of risk for their case.
Well, and let's look at this from an advisor's business perspective. You are going to be held to what the benchmark did. You're going to be held to an appropriate portfolio of benchmarks, and you're also going to be held to the benchmark of your underlying decisions. And both of those are going to be taken into consideration. And the higher of the two is probably going to be argued. So the reality is that if you're out there thinking you're going to read your analyst research report and make a bunch of stock picks on the top 30 things and do YOLO on NVIDIA or whatever else you're doing, if you had just done the empirically valid thing that is supported by evidence, you wouldn't have that risk exposure.
Yep. Jason, you and I often, we agree on most things, but we often disagree on the extent to which we should engage online with trolls, basically, or with people that we don't agree with. And we've talked about this.
Yes,
we've talked about our disagreement, and I actually do appreciate your logic on it, even though I don't agree with it. Can you explain why you fight trolls on the internet who are spreading financial BS?
Look, if this was like at a conference and one of these people wanted to argue with me, I'd probably just walk away, right? In a lot of cases. Sometimes I don't. It also depends on their footprint, right? Like, oh, this is a dividend blogger who thinks that, like, here's the reality. I'll go back to Edmund Burke, who said something to the effect of, the only thing necessary for evil to triumph is for good men to do nothing, okay? So I'm not going to assume that it's evil, okay? I'll assume Hanlon's razor, which says that, you got to assume ignorance over malice, right? And they're committed to their ignorance. That's fine. But here's the reality. These people may have an audience. These people may be gaining an audience. There's people who are watching. And one thing I learned about social media a long time ago was when I found out how many of my friends were following me and would comment to me, oh yeah, that was a really good conversation. I'm like, dude, you never comment. I don't even know you're on Twitter. Like, what's going on? So there's far more lurkers, people watching, than there are people talking, right? And these people are taking things in. So if we're not out there calling BS, if we're not out there fighting the good fight, I mean, like, there's a certain point you walk away and say enough's enough, right? If we're not basically throwing up evidence against unaccountable nonsense, who's going to do it? And people are going to start, more people will fall into the trap of thinking this is the case. There was a case about 2 years ago with a insurance guy in the US where, like, all of FinTwit united against him because he was so crazy. And like, he's like, oh, this is great. It's feeding me more business. I'm like, you don't understand. You don't understand all the people who aren't coming your way now because of all of us doing this. You think you're winning. You're only seeing this tiny, your selection bias is tiny. But point is that, like, look, it's simple. Give them, people will also, I'll say you this way, you can beat this baseless stuff with logic, math, and academic papers, right? Because most of it's completely baseless. It's based on total misconceptions of the universe. And you give people enough rope, you got to show exactly who they are. And that's when once they finally give up, they start attacking you and they start name calling and they start doing whatever. Great. Do you think you just won anybody over by name calling me, right? Like, you're so right about your argument that you went with a denigration, and yeah, maybe you're in a non, whatever, which means you have no courage in your convictions. But nevertheless, like, look, I've joked, it's a public service, and there's times where, like, so yeah, there'll be times where, Ben, you got it right. I mean, you're gonna go only so far, or someone else will go, and McGrath was pretty good at that for a while, or some other friends we have online will go, or Cliff Asness will just really blow someone up, and I'll just watch and eat popcorn along the way. Look, the reality is that on some level, it is a public service. We are basically, educating. Now, it's not the funnest form of education, I'll say that. My wife will often give me grief for it. But at the end of the day, like, sometimes other people are watching and other people are learning.
Why was it important for you to start the Financial Planning Association of Canada?
You want the origin story? I'll give you the origin story is interesting. So I was down at the FPA conference in the US several years ago, and I made a friend, and I wandered into the Next Gen group, which is like their young advisors group. And this new president was taking over, and he was talking with such passion about the opportunity they had to transform the industry and create something so beneficial to humanity that he was almost in tears. And I was just like, this place is incredible. And then people started, like, challenging stuff. I'm like, I stand up, I'm like, guys, really respectfully, I'm from Canada. We got none of your stuff up north. I wish I could take you all with me, because we got none of this. And frankly, like, please do everything you're talking about, because you're going to shame the rest of the world into doing the right thing. Like, just do it. And he says to me, why can't you fix it? Like, look, it's complicated, banks, blah, blah, blah. He's like, so no, but seriously, why can't you fix it? Like, I sit down, I'm like, jerk. All right, he threw a gauntlet. So I go up and talk to him afterwards, and he's like, he listens to me for about 2 minutes, like, so you're not the guy? I'm like, oh man, come on. So I came home, and this has started to happen several times, where I come home from American conferences a little bit depressed about what I was coming back to in terms of an industry, right? I was having these engaging conversations about fiduciary responsibility and elevating the industry and all this other stuff, and I couldn't find with hundreds of people. I couldn't find a dozen people have that conversation within Canada, and it drove me insane. So, I started talking to friends and colleagues about what the heck am I going to do? I can't do nothing anymore. I don't think we can do nothing. This was when title protection was starting to come about in Ontario, and we were worried it was going to go the wrong direction, and it kind of did, but we're trying to fix it. And I think none of us wanted to start an association, but we felt that there was going to be no other way to move the needle because we weren't happy with the representation planners had in this country. So we said, okay, great, let's build an association, but how are we going to make sure it's different? And how are we going to prevent it from being co-opted by those who don't have the same belief structure? So we came up with an end state. We created a charter that said, this is the world we are trying to create. Fiduciary responsibility, evidence-based, basically best interest of the clients with pure transparency, all of it. We basically said, look, there's no other way. There's no other way. We need to create an association, and the charter will serve as a filtering mechanism. And I'll tell you, man, that I get a bunch of hate mail about that charter. And I basically said, look, man, respectfully, as far as I'm concerned, fiduciary responsibility, transparency, all this stuff, that's me saying I stand for unicorns, puppies, and rainbows, man. If you don't believe in what we're talking about, congratulations, you don't have to join. You don't have to join, but the rest of us are going to. And a bunch of people early on, before we even launched, over 100 advisors planners took the leap of faith and let a bunch of us put this together. And now we stand at over 300 members strong, and we have an incredible community, an incredible engaged community that I'm touched by it all the time. I was meeting with a young guy today who basically is leaving his career because he wants to be a planner, and he thinks it's only possible because he managed to get involved in that pack and basically learn from our forums and get exposed to our education. And I'm sitting there going, this is someone who basically legitimately wants to build a better industry and do good for people, and he wouldn't have made a career change if we hadn't enabled and empowered. We've had President's List winners for the CFP's top three placements in the CFP exam, who credit the forums and the education to get with us to this. And more importantly, it's created community, right? It's created a community of people who basically we're no longer at an island. That's something I found with a lot of the right intentioned planners that have been around for a long time. The older ones was that they were on an island for so long they didn't have a tribe, right? And we created that tribe, so that's why it was so important. So, the only way we're going to win this is a ground game over time, which is why reaching out to the students and younger planners and right-minded people is that's what's going to win in the long run.
Yep. It is a great community and it's a great association. I'm a member. Mark McGrath's a member. Dan Bortolotti is also a member, but it's got a great forum.
Cameron,
I don't think Cameron's a member, but it is a great group.
Yeah.
And it's a great resource for people, like you said, Jason, that are coming into the industry, where there's a group of people with broadly shared beliefs about what the industry should look like. It's a great thing to have. All right, second and last question. Did Mark McGrath's soul actually leave his body in a hot sauce eating contest?
We have photographic evidence and video that it did, legitimately. At one point, for the record, he was looking down at his hands, hyperventilating, afraid he wasn't going to go on. And despite the fact that he had been trash talking and basically even when we sent him a cameo from Alton Brown telling him he was wrong, he would not digress. And his hubris got the best of him, and to his own admission, he was glad that there was a hospital not far from the hotel. Luckily, he didn't need it, but if he had tried to go any further, he might have.
Yeah, I was there. That was it was actually kind of scary. He was
scary for him.
He was cooking.
Ervin and I were perfectly fine.
Yeah, I heard Ervin was a machine with it.
Ervin was beyond fine. Ervin was enjoying himself.
I was sweaty, and I was like, okay, man, I'm feeling it. I'm feeling it. I'm gonna go lie down after this, but I feel it. But I'm not hyperventilating and worried about death. That's all. Just say that much.
All right, Jason, the final question.
Oh, boy.
How do you define success in your life?
Let me give you the it depends answer. It depends on what we're talking about. Okay. I thought about this in 3 levels. First, personally. Okay. Personally, nothing matters more to me than my children growing up and living happy lives and my wife being happy with our family. That's it. That's the most important thing in my life. It's my cornerstone. Okay. In terms of my business, the fact that I am living the most important thing, which is I get to sit across from people and help them succeed in life. And what I discovered years ago about myself was that I take immense pleasure in aiding everybody else's success. And I get to do that on a daily basis. And unfortunately, life will throw curveballs and negative things, and you will have some of the most horrific things happen to clients and people in your life you care about. And you'll be there to, this is the test. You'll be there to support them. So this is a truly profound and transformational industry that can do so incredible if we just do it right. And the last piece is the industry. Okay. Like, I just want it to be better than when I left, when I leave than when I found it. Right. I legitimately, everything we wrote in that charter was written out of pure love for what is possible and helping humanity. And frankly, if we can actually be a real profession by the time I finally say I'm out, nothing will make me happier.
Great answer. Great to see you, Jason. So great
Always
to
a
have
pleasure.
you on finally.
Some people denied my existence. I don't know.
Hey.
Yeah. All right, Jason, that was great. Thanks for coming on.
It's a pleasure.